Welcome to the University of Essex, part of the University Enterprise Zone, Space to Grow and Angels at Essex programs. We're talking today about investment readiness, and I'd like to talk to you today about exit strategies that entrepreneurs and investors should be looking at when they're dealing with their innovative ideas. My name is John Stenhouse and I'm the Business Support Manager from the University of Essex Enterprise Zone. And I will be interviewing today Dave Howard, who was the former MD of Game Group, running stores across the whole of the UK and beyond. And Mason Doick from Jenkins, one of the most established companies in the city for dealing with share transactions in unlisted companies. So I'll come on to more detail about both later, but first of all, I just wanted to mention to you that the number of inquiries we get from innovators, entrepreneurs seeking equity funding, investors for their good ideas, and the fact that they don't consider the exit strategies that they should be adopting. You need to make sure from the onset that you know where you're going with your business. Investors need to know what your future plans intend to be. And have you got a plan B? In these series of interviews, it'll give you a taste of real life, what's actually out there, and things that you should be considering at the very onset and building into your plans going forward. Failing to plan for the future means that it's not preceded by periods of stress and worry, and the future comes as a complete surprise. But we're not here to discuss surprises. We're here to plan for the future. And I think going forward, you need to remember that investors invest in teams. We're not all Dysons, we're not all Bransons. And if you remember, both Dyson and Branson have really good teams around them going forward. Investors like to know about continuity. They like to know that the future is bright and that the operation will actually be able to grow at the speed with which entrepreneurs advertise that fact when they prepare their pitch decks. Welcome to Angels at Essex, our Space to Grow program from the University Enterprise Zone. I have with me here today Dave Howard, former MD of Game Group. And Dave is going to talk to us today about the kind of exit strategies you're likely to come across, both as a founder of a business and also as an investor. So first of all, Dave, tell me a little bit about yourself and your background and who you've been working for of late.
Okay, so most recently I've been working for Game Retail or Game Digital. A little bit of background on me, probably 35 years in retail, a long time. Started on the shop floor, worked my way up, started working in a company called Lasky's. Those that can remember, Lasky's is a very old electrical hi-fi brand. Started working for them as a salesman. That business was acquired by Comet. So there's a common theme here. I've been in businesses that constantly get acquired over the years. And I stayed with Comet and Lasky's for probably about 13 years doing electricals. I decided a new direction. Ex-colleague of mine went to work for Blockbuster, so I had an opportunity to go and work in the entertainment industry. And I started working with Blockbuster, enjoyed that as a senior field manager. And Blockbuster bought a company called Game Station back in 2002, 2003. Which was a small business at the time, and gaming was a growing industry at the time. And yes, I worked for Game Station and took them from 50 stores to 270 stores. So that was an interesting journey. And then Game Station got acquired by Game Group, as it was at the time. And that's where who I was with right up until tail end of last year. So that's a very whistle-stop tour on the journey. Worked my way up from being a field manager and operator to director level.
So you've been through some massive changes in retail operation throughout your career,
Yeah.
and some big names there as well.
Yeah.
So which came first, buyout, takeover, administration? Tell us a bit about the first buyout situation and how it worked out.
So the first buyout really that I experienced was obviously Blockbuster buying Game Station. I wasn't at a director level at that point, but I was a divisional general manager effectively. And what was exciting about that, Game Station was a relatively small business versus Blockbuster International worldwide business. But what was exciting was I was pulled out of Blockbuster to go and work on this project, which was we want to take Game Station, we want to take it from 50 stores to being a national chain, to be a direct competition with Game, who I now work for, or I did work for. So it was an exciting time. Lots of investment from the parent business to say we really want to get a foothold in the UK. We want a slice of the gaming action, and we believe we found a business that will we can invest in and will get us there. So my experience was massive growth, big expansion, very short space of time. We were opening 6 to 7 stores a week, so extremely exciting time for us. So that was the first experience I had. And then back in 2007, Blockbuster were looking to exit the business to focus on their core business. The core business got in a lot of trouble. All they wanted to focus on was the mothership effectively. So any businesses that they'd acquired, they were looking to dispose of. So we went on a process of getting interest in the business. We had another company called GameStop from the US that came in, again, looking to take a foothold in the UK. Spent a lot of time with the US guys, getting them around the UK. They invited us out to the US to look at their operation. And we've got right to the end of an acquisition process. Everyone was excited, and it fell short right at the 11th hour. So there was a disagreement. They couldn't resolve it. Emotions were running high. And basically the deal fell apart. What then happened while this was falling apart, Game sneaked in and put an offer to Blockbuster International, said, we will buy it. We will do no due diligence. We just want to buy it. And we can complete the transaction in a very short space of time. And do you know what I admire about Game at the time was they were doing it to protect themselves.
Gotcha.
They were saying, we can't afford GameStop to buy that business. If we do not move now, that business will be bought by them, and we've got serious competition against their own business in the UK. So within 24, 48 hours, we went from being part of GameStop to, oh my God, we're with the enemy now. We're with Game. And, no one predicted that to happen. And then after that, obviously, because the transaction was done so quickly, there was a lot of complaints, and there was complaints from British retailers and GameStop themselves to say, Game now have a monopoly in the UK.
Right.
And so what then followed was 2 years worth of competition committee investigation. And in the end, they found it was a lawful transaction and Game could carry on, Game Station could be part of Game. But in that time, those that were working in Game Station couldn't mix with those in Game. There's 2 businesses had to be kept separate while this investigation was going on. So it was a bit of it sort of delayed the integration of Game Station into Game.
Mm-hmm.
And then the next chapter was what normally follows, or what I've seen follow a lot of retailers that have acquired businesses through not doing a lot of due diligence, not watching what's happening with the market. And the problem with the gaming industry is it's very cyclical. So as it was then, it was PS3 and Xbox was the mainstay, and the cycle was coming to an end. And unfortunately, Game Group, which own businesses in Spain, Italy, Australia, France, and the UK, was over leveraged. They borrowed money to buy a game station. They were overcommitted. And then all of a sudden, we've got 600 stores in the UK. We can't support 600 stores. And then they were desperately seeking new buyers for the business or refinancing of the business. And unfortunately, and I'll talk about this in a bit more detail, administration was on the horizon effectively for the UK, certainly. So Game has been and then post administration is a whole new there's a whole lot of different activity which I'll come on to. But yeah, Game up to the point of administration was very stereotypical of what happens with a lot of retailers. Big expansion, loads of new stores, not keeping an eye on what's happening with the market, not controlling costs, over leveraged on borrowing. We've seen it most recently with Debenhams. Too much they owe the banks, no maneuverability. And then you're into this situation where administration is the only outcome to restructure the business.
So a lot of people fear the word administration. How did, in this particular circumstance, how did this work out? How did it work to the advantage of the business?
Well, there was a lot of work. I mean, I'd never been involved in administration, and I was a divisional director at the time. We had PwC come in. What I was asked to come in, this was probably a month before administration, and I met with the PwC team, and I was seconded to the PwC team to help do all the work that was necessary to. They were saying, look, we want you involved because we're looking to if we were going to reshape the business tomorrow, what would we need to do?
Right.
So we did a lot of work in the month up to administration. The business started in February and the business went into administration in the March. And so we looked at stores, we looked at profitability of stores, how many stores in each town, and what would be ideal. And the problem with all these acquisitions over many times, in some towns, like, for example, those that will know Hemel Hempstead, Game had effectively 3 stores in one town. So you think, actually, now one is sufficient. So you've got 3 times the staffing costs, all the rent, the rates, and service charges and everything else. So they wanted someone that got the business, got a bit of geography of the UK, and go, okay, Dave, blank sheet of paper, what does the store estate look like? What stores would we keep? What stores would we not keep? Which sounds quite draconian, but it had to be done. And then following that, we looked at all the structure charts of the business, and I was only looking at the UK business. It was a separate team looking at the international business. We looked at all the structures. What do we need in commercial? What do we need in operations? What do we need in distribution? So we looked at all the org charts and streamlined those as well. Now, what we were told was, whilst we're working on this, they were actively seeking new buyers for the business and new finance. And there was interest in the business. But I think the challenge that buyers had was, I like the business, I don't need that many stores, and I don't want to be taking on all those leases. Some of those leases would be 10 years. So unfortunately, what happens and what makes it really desirable for administration is all bets are off, all leases are null and void, and the business gets a clean break and a period of administration. It's very disruptive to the business and your consumers. Don't forget you've got customers involved in this as well. But it creates a lot of emotion. I look back at it and think it was the only way the new business could move on to a new platform, and the business had to be reshaped. It was cumbersome, it was too much cost. But it was a very emotional time, not just for the staff and the people that work there, but for the suppliers, your partners. You've got to try and bring everybody on that journey. Yeah. And unfortunately, one thing I reflect on after administration, and if my chief exec was here, he'd say the same thing. People have got long memories. And unfortunately, even though Gain was a new business come the day after the 26th of March 2012, the way your creditors look at you is it's still Gain.
Yeah.
And you burnt me for money, and I'm never going to forget. And it's a repairing of trust, and that trust probably would never really be healed, but it took a long time to get everyone's confidence back in the business.
Yeah.
But I look back at it and think, actually, it was the only route for Gain. There wasn't any other route other than, administrations are there to try and, if there's a business that can be saved, then it's a route forward. Yeah. It's not the best. I wouldn't recommend it as the best way, because sometimes you're better off bringing all your partners with you, your colleagues with you, and everyone that works in the business. So if you're going to sell the business or move it on to new ownership, try and bring everyone with you.
Yeah.
But in Gain circumstances, there was no other way.
That's really interesting to hear the real life scenario rather than the textbook versions that we get presented with. Tell me, we got up to 2012, Gain's now out of administration.
Yeah.
You've got the problems of previous creditors and what have you. What followed next? How did it pan out from there?
It was a period of uncertainty, because literally the day you come out of administration, again, I wasn't in a director role at the time. I was a senior divisional manager for the business. When the day that the business went into admin, the chief exec was fired, the CFO was fired, the administrators fired them, basically. There was a handful of directors remaining. So as senior leaders, we were a little bit, what's going to happen? Where do I stand? Am I still going to be here, etc.? So there was a little bit of, I remember at the time I'd even got an escape route for myself to go and work somewhere else because of the uncertainty of it all. And then my old boss, Martin Gibbs, was invited back to the business to head it up as the new chief exec of this newly formed business. Working for Elliott's Elliott's advisors bought the business out of administration, and they appointed Martin. And I remember Martin calling me, telling me he's my new boss, or effectively would be my new boss, and that could I come to the office because we haven't even got a bank account yet. We can't take credit cards because we've got no arrangement with the credit card companies, because effectively this new business that's been created overnight has got nothing, literally nothing. We had a pot of money from our new owners to bankroll the business, buy stock and all of that. We had no credit, obviously. That was interesting. And Martin at the time, who had the relationship with the suppliers, literally overnight started to try and repair. If all you do is sell what other people make, it is the biggest priority, which is, unless we repair these relationships, we're not selling anything. So that was the big thing. And the other strategic thing that the new owners did was they got Martin, because Martin he's got 20 odd years in the industry. So they needed someone that the industry trusted.
Got you.
So Martin was a very smart recruit for them, because overnight they leveraged Martin's relationships, basically. So then very shortly after that, Martin decided he was going to reshape his director team. And I remember I was in a senior field role, looking after effectively a third of the country. And he invited me in to come in and said, look, I want you to be my retail director. So that was my step into the director world back in 2012. So then I was part of the team that let's reshape the stores, what the store's going to look like, what's our offer going to be about, in amongst the market that was still quite challenged, because we still didn't know then there was going to be a PS4 and the new Xbox One. That still wasn't, we had a glimmer that it might happen. We knew that there was a new cycle on its way. And then obviously in 2013, the new cycle started, which was, which catapulted the business back into some really good times again. And that led us into the next big chapter, which was our owners wanted an exit route, and how are they going to get the best return on that investment? Which was, they looked at lots of alternatives. Could we sell the business? But the one they came up with was, let's IPO the business. Let's float the business on the market. And that was a long process. It probably was, all in all, from start to end, a year. Easily a year. And again, you know, you're building, all games have fallen business. Why would I want to invest in it? What makes it a good IPO candidate? But we got the banks helping us with it, and running the book, etc. But for Elliott Advisors, they raised 121 million in capital. Good sum. So good sum of money, which some of it got reinvested in the business straight away. And in that process, they still maintained quite a significant stake in the business. So they were a shareholder in their own right. So they made quite a significant, or the largest shareholder in the group. Interestingly, a lot of the investors would only invest if Elliott stayed in. What we call we called it the herd instinct. Investors like to know that someone else is also investing and is possibly even taking a lead in that investing for them. I think Elliott's have got a lot of credibility, and I think it's saying, okay, if you've got skin in the game, then I'm more confident. It was a great process. I really enjoyed it. Met a lot of people, met a lot of investors from, I mean, my involvement was more presentations. My boss, the chief exec and the CFO, did a lot of the donkey work. What they did with me was roll me out to talk about stores, talk about our people, because they just want to know let's understand about the business, what's it about, the people that work there. So I did a series of presentations, talking about what we want to do with our store estate, what do our stores look like in the future, what do our people look like, what our aspirations are, and where do I see the market going. One of the things that they were super keen on was that the digital market was growing, and how were we going to compete with that? Because they saw that as a threat. Because investors invest in teams. It's not just the CFO or the CEO. It's the team. It's the team. And they like to know that the team knows what it's doing, can cope. If the CFO was removed, the team can still function and move on. And I think that's very important from an investor's point of view. Carry on. What they liked about the business is they liked the specialist culture of it. They liked that we were trialing lots of new things to change the experience of what you get when you go in one of our stores. And one of the things that was born out the back of that IPO process and the investment that followed was we shortly afterwards we bought a esports entertainment business called Insomnia that runs events out of the NEC in Birmingham. We also created a business called Belong Gaming Arenas, and that was true experiential type business. It wasn't necessarily, retailing was a side shoot of it. It was mainly about people coming in, competitive gaming, and having a venue where they could go and engage with gaming on Xbox, PlayStation, or PC. So something completely different. And you know, and that's where, if I was to talk about game going forward, Belong is probably going to be one of its biggest futures offspring, which is last year the Belong business was sold to a company called Vindex, which is an esports platform company, a new business in the US that are building a competitive gaming platform that people can engage from all around the globe. And they loved the Belong gaming arenas, so they bought the brand and they bought all the rights to it, because they believe that in the next 5 to 10 years these gaming arenas will be all over the world. Unfortunately, during the time between 2014, when the IPO concluded, and probably 2017, 2018, guess what follows? The cyclical market starts to decline again.
Yeah.
And the challenge this time is commitments made to the city on expectations.
Yeah.
And, you know, someone did say to me, be careful what you wish for when you do an IPO, because what follows is big commitments to the city in terms of targets and aspirations. And we were finding it super, super tough to get to some of these targets. And as a result, the business took a little bit of a torrid time in its share price. And then the next chapter started where Mr. Ashley and his team bought several big shareholders out, and he acquired 25% of the stock back in, I think it was July 2017. He bought a 25% stake in the business overnight.
Yeah, and we're talking Arcadia. Yeah.
No, we're talking Sports Direct, Mr. Ashley. So Notorious, which is now Fraser Group. So overnight, we were getting a phone call from Mike Ashley. Can you come and see me in Shirebrook? I want to understand more about game. I want to understand about this Belong business. And then a new chapter started. What was interesting is, those that know Mike, that's how he dips his toe into a business. He'll buy a stake in it, get to understand it. I honestly think they probably thought the business was vulnerable because of the stock price was very low, 25p or something at the time, I think it was. So I think Mike's always in for a bargain. So he's thinking this business could topple and I could be in the front row seat to acquire it. So, but what followed Mike buying into the business was Mike was super keen to do a collaboration agreement with Belong Gaming Arenas. So, so what Mike liked was how Belong could fit into their new strategy of trying to create more experiences in their own stores. And yeah, he bought into the business, and we had an interesting relationship with him right up till 2019, which was a frustrating one, because as much as game was our priority, it wasn't his priority. And I think Mike got an opportunity to buy more stock, and I think it pushed him over 30%. The trigger was 31%, and then he had to put in an unconditional offer. So back in 19, at the beginning of 19, Mike had the opportunity. Overnight, he had to put a declaration out. He was interested in buying the business, and he was he has to formally put an offer forward to the rest of the shareholders. And he bought all the other shareholders out in 2019. So basically, August 19, Game was changed ownership from being PLC to part of the Fraser Group business.
I mean, it's interesting. I can see that you had to keep the innovation going the whole time. You had to stay ahead of the market and keep abreast of what was happening, not only in the UK, but internationally as well. And it's that constant innovation, and it's led by the teams, isn't it? It's, you know, the teams are leading the innovation by keeping their ear to the ground and keeping aware of what's going on.
It was a couple of things. It was, we had to innovate. We had to keep innovating because the gaming market is such fast pace, and retail is changing beyond all recognition, and retailers have been accused, rightly so, of being too slow to change. And whilst all this is going on, we're having to save costs, make efficiency savings because the sales weren't there, thus the margin wasn't there. How do we keep the wall from the door? We didn't want to, because we'd all seen an administration process, we don't want to visit that again. And we had cash in the bank. We weren't over leveraged, so we were just being very, very prudent. Lots of lease negotiations went on all our lease renewals. The great thing about Game is Game signed all its leases at the same time, because one of the beauties of an administration is all your leases start at the same time again. So they all get renewed at the same time. So we had a perfect storm with landlords to renegotiate and re-gear all our leases, bring the costs down. We restructured our staffing costs, restructured our all our central costs, and whilst doing all that, innovating and pushing ahead with Belong, because we knew that retail is going to change beyond all recognition. And actually, if there was going to be a saviour here, you've got to keep that precious thing going. And I think in essence, one of the reasons Mike bought the business is, one, he liked the Belong gaming arenas, and two, he felt there was a good business there, but a business that if he dovetailed it into his own estate, i.e. take away all those all of those physical estate costs, is actually a profitable business. And could sit alongside his sportswear business, and it does. You know, it's in the next year or so, I wouldn't be surprised if every Game store is in a Sports Direct or a Fraser Group store of some description.
You know,
and that model works. And that model works. And I think generally in retail, you'll see a lot of that happening over the next few years, where you'll see other retailers cohabiting with other retailers in a collaborative way to share space. We've just seen it with Marks and Spencer's taking in brands. You know, something they should have done 5 years ago, Jules and Phase 8, all going into their stores to share space. It makes complete sense. And another reason why you'd go into the store.
The shopping experience.
And that's what Mike liked about the business. He was very honest to say, look, you know, gaming customers will bring more customers into my stores. You know, it makes complete sense.
Almost a generation thing as well.
Absolutely.
Now, Dave, thank you so much for coming in and talking to us today. It's been a real eye-opener into the world of commercial retail and how things don't, they can go pear-shaped, but there are always exits in whatever form that is. And you shouldn't be afraid if you're going into B2C and you are an equity investor going into B2C. It's good to be forewarned of what could happen and how you can react and how you can anticipate what could happen, to have those plan Bs and even plan Cs in place.
Yeah, and I think that's one thing, certainly the director team that were part of Game at the time when I was a director, our reflection is always have 2 or 3 plans. Don't wait till it's too late to do something. I worked with several retailers. I even worked with Maplin, and they went into administration. They didn't deal with their cost base quickly enough. And sometimes you've got to make some difficult decisions. The key thing is, if you're going to make them quickly, because it's good for the health of the business long term. And always keep cash control at the heart of everything you do, because cash is king. If you're managing your cash flow exceptionally well and you're controlling your costs, and you're paying your suppliers, you're keeping everyone happy and keeping them in a place where they're not worried or concerned about the business and start changing their behaviour. Because, as I say, one thing about administration, it creates a breakdown in trust. And if you're working with multiple partners, it's hard-earned trust, and it's very easily lost, and it does take a long time to build it back up. But spot on advice.
Thank you, Dave. Words of wisdom. And I thank you very much on behalf of Angels at Essex, our University Enterprise Zone project. Thank you very much, Dave.
Thank
I
you.
wish you all the best for the future.
Thank you.
I'd like to introduce today Mason Doick, who's the Head of Corporate Development at JP Jenkins. So Mason, tell me about the history of JP Jenkins.
Yes, of course. The history is incredible. It's one of those things where I always say, where do I start? It's 31 years old, JP Jenkins, founded in 1991. The co-founders, John Jenkins and Paul Brown, founded it actually with alongside the OFX market, which did incredibly well in the early 90s, late 90s, early 2000s, and raised actually over 1 billion for UK SMEs, and did incredibly well. When the OFX obviously went through a number of name changes, it sort of diverted away from JP Jenkins, and now is obviously the Aquis. But of course, JP Jenkins has always remained that, in inverted commas, a private stock exchange, a way in which investors, shareholders, companies can buy and sell those shares in private companies, unlisted and unquoted companies. It's been an incredible 25 years. Over that time frame, we've had most of the Premier League football clubs, all the likes of Arsenal, Man City, Liverpool, West Ham, Aston Villa. I mean, the list goes on, until, of course, they were bought out by oligarchs and single American corporates, unfortunately. And then all the way through to Weetabix, NCP, Adnams, Shepherd, these great best of British brands that we see now on the LSE, the main market and the junior markets in the UK have used us as a stepping stone for that as well. So the history has been incredibly strong. Unfortunately, John Jenkins isn't with us anymore, but we're lucky enough to have Paul Brown, the co-founder, is still with us as our head of dealing. And it's now that we're at the stage where we've built our new online trading platform, and we're looking for some new exciting businesses to join.
What other services can JP Jenkins provide?
Well, it's actually quite a good question. There's a number of services, and we've really opened up the doors to the marketplace and to the wider investor audience and the companies alike. The traditional platform is our bread and butter, and that has been a trading facility for private companies, purely broker to broker. So it's settled through the UK electronic settlement system, CREST, and that was, of course, our main business model for those companies that joined us. Recently, we've actually had a really good development over the last 12 months, and we've built a tech-enabled system called Direct. And this is now our online trading platform that we launched as of Q1. And that really has opened up the doors to a lot of early stage businesses. The problems we found with traditional is that these early stage businesses didn't want to go through the rigors of maybe having a registrar, their LEI, their ISIN, and maybe acting like a public company wasn't so attractive to them at that time, at such an early stage. So this direct platform has really allowed them to admit to the platform at ease. We don't require strenuous reporting standards. It's a very simple admission. As long as the company's a registered company and we can check that the filings and accounts are up to date and the KYC and AML, the board is suitable, then it's a very simple admission process. And that essentially allows, with that, the direct platform allows us to do private SPACs. So you've seen a huge flurry in the US of SPACs on the public markets, which of course are quite costly when you're sat on a public market paying the admission fees, the nomads, the corporate finance, corporate brokers, the prospectus fees. It can be quite costly. So we've opened up the opportunity to list a private SPACs on our platform, which we're actually launching our first one as of next month or so. And then also cross-border capabilities. So when we were using our traditional platform, we could only utilize UK companies or jurisdictions around the world that could somehow correlate to the UK settlement system. Whereas now with our direct platform, we can have companies based in Hong Kong, companies based in Australia, which we've got potentially looking at the joining. We've got, the Eastern Europe, pretty much everywhere and anywhere that we can essentially utilize and get the updates from the companies. And there's that good communication channel. Then we can have them either dual list or use the cross-border listings on our platform as well. So it really opens up that offering and suite of services, and hopefully many more businesses to come and support. Mason,
tell me a bit about yourself and your background and your role there at JP Jenkins.
Yeah, of course. So My background, I've been within finance and private equity for over 5 or 6 years now, so limited experience, but enough to know the errors and issues that are around liquidity. I previously started off in investment management and then went through to private equity, raising capital for equity and debt within EIS. Great investment scheme, obviously founded out of the early 90s. But of course, there is 1,000,001 inroads into these investments and little exit opportunities or liquidity solutions, which naturally led me to JP Jenkins in managing their head of corporate development and assisting shareholders, investors, companies alike with a liquidity solution within the private market. So I now have the main sole responsibility of finding some incredibly strong businesses and making sure that I can assist those angels, those early investors, those families, friends, directors with a solution for a liquidity option without having to bang on the founders' doors to provide an IPO, an MBO, or a trade sale or something alike of some sort.
That's really interesting. So tell us a bit more about the solutions that you actually provide, both for you mentioned both for the founders and the investors. So let's talk about the investors first. What kind of solutions can you offer investors?
Of course. Well, I mean, JP Jenkins it has been around for 31 years. Incredibly strong business, legacy business. It traces roots back to the unlisted securities market, the USM market. And the main mission for those founders of JP Jenkins and the OFX, they actually co-started as well, was really to provide those investors and those shareholders an opportunity for liquidity. We find that investors always have one eye on the exit. There's always the first question out of maybe the 3 or 4 first questions. Is there a route to liquidity? Is there a plan in place? Is there an opportunity for an exit pre-IPO, or is there a trade sale competitor that's going to buy us out? And that's always one of the questions that comes into play when you're looking through a 30, 40, 50-page IM and the financial forecasts. And realistically, having a secondary market is really beneficial for those investors and those companies. There's no worry that they're going to be locked into an investment for 10 to 15 years. The investors have peace of mind that when they're investing in these schemes, whether it's EIS, SEIS, investing in pure equity, or any other option or asset class, that there is a liquidity solution for them. I think from the investor standpoint as well, there's always the issue that companies often tend to only come back to those investors when they require more capital, which can also be a concern, and there's a problem with sort of reputation for the company and credibility. So from the investor's point of view, having a secondary market like JP Jenkins, a liquidity solution where their company potentially that they may invest in is listed on the marketplace, and they have an opportunity to review company updates, regular information, regular reporting. And I think from the investor's point of view, they've got peace of mind that not only they've got a liquidity solution, but they've also got a way in which they can simply log on, see the company updates, see the management, see the maybe changes in the board or directors. They can see an indicative price, they can see the last traded price and the volumes in which they are traded as well. So it really does give them that opportunity and full transparency, which you may not get with all investments that an investor may look at or private company.
We are talking about both quoted and unquoted companies here, aren't we?
So this is just for private companies. So this will be purely for companies that are not registered or not listed on a junior market or main market, purely private companies that have from early stage all the way through to post Series A. And it's really, JP Jenkins is seen traditionally as a stepping stone for listing. So if a company does wish to list, they can utilize our services to get to that point. So with our traditional platform, we can help companies with their LEI, their ISIN. We know all the main registrars in the city obviously fairly well over the last 30 years, the corporate brokers, advisors, nomads, legals. So we can really get their ducks in a row and assist them with that IPO process. But in terms of our conversation today, in terms of liquidity, it's mainly focused on the unquoted space, the unlisted markets, and the private companies themselves.
So effectively, an investor who's invested into a pre-Series A, a seed business, who has perhaps been with them for a while. I think you mentioned that that business might be seeking more funding as well, and the investor decides that he doesn't want to continue with that particular company, so he's put under pressure to invest into his original investment, but for whatever reason he wants to move on, perhaps go into another investment elsewhere. You can provide a solution for that.
It's a great question. I think it's one of those things where a lot of companies we actually deal with, the founders, of course, don't want any investor or portions of investors to be running at the door as soon as there's a liquidity option. That's not why we're here at all. It's purely for, as you said, if there's one investor or a selection of early investors that think actually we might be able to access a liquidity solution. A lot of our companies, and one in which is doing incredibly well, Cheeky Panda, that's on our platform, they had some early stage investors from the very, very beginning who are incredibly in love with the business. It's doing very, very well. There's no reason whatsoever to sell out that company. And they thought, actually, we can maybe take a little bit of profits, we can sell a few of our shares, but realistically, we want to hold 99.9% of those shares still, essentially. So it's an opportunity for companies, early investors, to top slice their position, maybe take their initial stake off the table, but they can keep their remaining holdings. Or, of course, if they are at odds with that investment, or they're thinking, well, I've been in this for a long time, then there's an opportunity for me to sell those shares. And the second point, I think, which you said in terms of looking at other ventures, another thing that's really important about this, having the secondary market solution and a trading facility for private companies and their shares, is that recycling capital, that pivoting capital into further ventures. As we all know, there's only a finite amount of capital in somebody's pockets, potentially. As I know too well, working within private equity and raising capital, there's only so many times you can go back to an individual investor asking for them to maybe follow on into a business. And, you know, having the opportunity of liquidity, whether they require that or not, is so vital, because there's an opportunity for them to realize maybe a return and get some liquidity on our platform, and then put that into other ventures or other businesses through the Angels at Essex, or another, you know, opportunity that springs their way, and they think, well, we can actually benefit from that because now we've got some liquidity. There's always the case as well that out of, you know, the more darker side of our business, which I don't like to touch on too much, but of course we are inundated with probate lawyers and various problems with lots of portfolios of shares, but there's no way in which they can provide that liquidity. So having this option here, Mrs. Smith or Mr. Smith, God forbid their partners pass away, are not left with the burden of a number of share certificates and no way in which of realizing a return and accessing that liquidity as well.
That's a really interesting situation. I mean, say our platform, Angels at Essex, is over a year old now, and some of our investments are now moving into Series A. And I can well imagine that the original reason why people invested in these businesses was because they were seed businesses and they wanted to give them a boost into that area. And they may wish to keep their investments into seed businesses because that's where they see their potential and their growth. So I can well imagine there'd be some interest from some of our existing investors in some of our programs who want to go forward on that way. So let me ask you a bit about founders, because you mentioned that founders can use this as a method as well. Please explain that in a lot more detail.
Yeah, of course. So the way in which our platform is ran is that, of course, we need to speak to the companies and they need to be all on board to be a part of the marketplace. So, of course, we do have shareholders that want to access liquidity. We have angel investors, early backers think, actually, we want some liquidity. But it is, at the end of all those conversations, it is the company and the founders and the board that need to make that decision and basically provide this opportunity to their shareholders. So for founders, it's going back to that initial point. So one of the points in which founders will use this platform is the fact that they can leverage a higher capital raise. So if they're raising capital externally or they're doing a fundraise, they can usually seem to raise a higher amount of quantum of capital because they've got a liquidity solution in place. Secondly, to that, a lot of founders and boards of companies, private companies, come to us and they say, well, actually, we can use this as a PR method. We can use this as a visibility to a wider investor audience. It's one of those cases where we speak to a lot of companies and they say, well, we've actually just spent recently, well, over the last 18 months with lockdown, we spent, £10,000 on a press release, or we've done one article in an editorial. And we didn't actually get much traction because, of course, nobody's reading the papers, nobody's on the tubes, nobody's traveling. And we're probably inundated with so many emails, we don't get the time to read all of these bits and pieces. So some early stage businesses look at us, actually, we're not going to use the platform a great amount for trading. And we don't maybe have a huge existing cap table that want to sell the shares, but we can use this for a PR press release that we can do on each company on a quarterly basis. Or we can put out some new, exciting, sexy, glamorous story that company has done, or a new acquisition or new product, new service. We used our socials and our social channels and our mailer to our large community of investors to then put out those news and that feed of information. So it really is benefiting from that wider community and audience. On the flip side, of course, there's always the way in which some founders look at us as having a quoted price, having a quoted valuation, having a trading facility, having a way in which that they can incentivize staff, share options, equity options in the business, that then people can log on and see, actually the share price is this price and there is some liquidity, and if I wish to sell, I can sell, or if I wish to buy more, I can buy more. And it's really that incentivized option really builds sort of a culture as well within the business, and the founders feel like they're actually, or the investors and shareholders actually feel like the founders are putting them at the forefront of the priority, which creates that real nice credibility and reputation within the business. And then when the founders do actually go back to them looking for maybe further funding, there's that good relationship already there. So it really depends. The founders can benefit greatly from the platform, not just the trading, but everything else that comes with that as well.
So how close do founders get to the investors? Because on a typical platform like ours, we expect the investors and the founders to actually talk, and for the investors often to give help and support to the founders, because that's a way of developing the business that further, that expertise which comes with the equity. Does that still happen with your platform?
So a lot of the companies that utilize our platform have an opportunity to speak to the investors and the sellers. So of course, a lot of companies that come to us will then have maybe a number of investors. For example, for one case study, there is a company, of course, that have a number of shareholders that wishing to sell, and they also know a number of investors that are actually interested in buying. They've pre-approved these investors. They know that they're going to bring the smart money. They're going to, as you said, help utilize that business growth. And then they utilize our platform so they don't have to worry about the administrational nightmare of all those transactions and trading and updating the cap table, acting as registrar, and so on and so forth. There's also other companies that think, actually, we want to utilize your platform, but we're going to have a step back, and you can manage the process. They'll give us a set sort of criteria. And as long as that fits within their criteria and their brackets, then of course we manage those investors, those buyers and sellers. There's also then, as you said, the more hands-on approach. Some companies say to us, well, we want to be more hands-on. We want to know who's coming onto the cap table, what sort of investors are coming into the business, what, as you said, they can bring to the business in terms of what they can provide in terms of mentoring, consulting, coaching, whatever that may be. Then through our online platform, all the buyers and sellers are matched at that indicative price. So there's no wide spreads. There's no problems that you may find with the public market or anyone running up the books as market makers, but those buyers and sellers are matched at that price. And once they're matched at that price, and yourself, John, maybe is buying shares off me, or I'm buying shares off you, and we think, great, that's 100 shares, I don't know, 10 pence, 50 pence, pound a share, we're happy with that. That then goes to the company. And then the company can then review that on their page on the platform and say, actually, I know John, he's a very good man. He's going to bring us lots of business growth and utilizing the support and smart money, whatever that may be, and they can accept that. Likewise, if they're not happy with those arrangements, or the buyer and seller themselves, or maybe a competitor, they don't want sniffing around on the cap table, then of course they can veto that for whatever reason. And it purely is to have that safeguarding capacity for those early stage businesses.
Thank you. That's very, very good indeed. I think it really is a useful tool to have in the, if you like, the exit strategies. And at what kind of stage would you say a founder should engage with you? Is it at the very, very beginning when they're looking for investment, or is it once they start getting investors on board?
For most companies, it doesn't make, for obviously pre-seed stage, very early seed stage, it needs to make commercial sense, of course, for a company. And if it's sort of one founder with no other shareholders on the cap table, then it may not be, of course, the most suitable solution at that current stage. Of course, it may be as they grow, they will utilize the platform. But I think the real sweet spot is a company that's gone through maybe a fund round or a number of fundraising rounds, has a sizable cap table, or an investor shareholder base. They want to utilize that share trading platform for the said reasons that we've mentioned. And it's at that point that they can then benefit from the platform. So it's more after they've gone through a number of fundraisers, they're looking at the potential of having a secondary liquidity solution. Even though I say this, but in terms of the actual marketplace itself, it's incredibly wide ranging. We've got early stage businesses pre-revenue that are $1 million, $2 million, $3 million, $4 million market cap. And then we've just obviously got another company that's joined us, which is 150 million market cap. So it is very wide ranging, and it really depends on what that company requires and what they want to take from the platform. But it is useful for very various stages of these companies.
Thank you. So if people want to get in touch with you, obviously they can contact us and we will pass them on. But if they want to get in touch with you direct and find out more and perhaps have a discussion, how can they best get hold of you? Yeah,
of course, it's the main question, I think. So obviously I, as head of corporate development, manage the overall process of companies that are looking to be admitted to the platform, and the initial sort of admission process. But also I do actually help with managing our team with the admission of potential investors and shareholders as well that are interested in the platform. So certainly feel free to get in touch with myself either through my email, which is md@jpjenkins.co.uk. Also, of course, you can see our website, which is www.jpjenkins.com, or of course you can find me on LinkedIn as Mason Doick at JP Jenkins.
Thank you, Mason. That's been really illuminating, and I thoroughly enjoyed hearing how you can help both our investors and our founders on our platform go to their next stage. So thank you, Mason. Thank you very much indeed.
Thank you very much, John. Lovely to speak to you.
So thank you for listening today. I fully appreciate the fact that these sessions were actually pre-recorded due to the fact that people are very busy now that we've all going back to work after lockdown, and people are in great demand. So getting the same people in the room at the same time can be quite difficult. But that's the whole concept of our equity platform, in that it's a shop window to be able to advertise those innovative ideas to investors at their leisure, which is the best way of meeting those. I hope you appreciate the frank and open discussion about buyouts and mergers, IPOs, takeovers, and administration, which is always a last resort. But nevertheless, they do happen, and you should be aware of them. And remember, as an investor or as a founder, there are the unlisted securities markets that you can actually trade those shares in quite legally and above board. And that is a very effective way of actually moving your company forward or moving your investments forward to make more profit elsewhere. Thank you so much for listening today, and enjoy your safe journey home.